Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
I drink to make other people more interesting. Ernest Hemingway. You can't have everything. Where would you put it? Stephen Wright. The avoidance of taxes is the only intellectual pursuit that still carries any reward. John Maynard Keynes. Democracy is the theory that the common people know what they want and deserve to get it good and hard. A consensus means that everyone agrees to say collectively what no one believes individually.
The AI boom is creating trillions in market value and eliminating plenty of jobs along the way. So far in 2026, Oracle leads tech layoffs with 30,000 cuts, followed by Amazon at 16,000, Dell at 11,000 and Meta at 8,000. That's happening even as many of these companies are reporting strong profits and ramping up AI spending. The reason is simple. Firms are reallocating resources. More money is going into data centers, chips and AI infra. Less is going into layers of management, support functions and duplicated roles. It's a strange moment. The technology sector is simultaneously expanding and shrinking. A few years ago, the dominant narrative was China is uninvestable, isolated and in decline. Yet in just the first 5 months of 2026, more than 20 world leaders have made the trip to Beijing. Why? Because geopolitics follows power and power follows economics. Despite its property crisis, demographic challenges and trade tensions, China remains the world's second largest economy, largest manufacturer and a critical trading partner for over 120 countries. What's striking is the contrast. While headlines often focus on China's problems, presidents and prime ministers are spending an awful lot of time waiting outside Xi Jinping's office. In diplomacy, revealed preference usually matters more than public rhetoric. This does not mean China is winning everything. It does mean reports of its irrelevance may have been greatly exaggerated. 10 years after its launch, India's Insolvency and Bankruptcy Code, IBC, has arguably achieved its biggest goal, changing behavior. Before IBC, promoters could default, delay, litigate, and often keep control. Today, the threat of losing the company is real. In many cases, just the possibility of being dragged to bankruptcy court is enough to get borrowers to the negotiating table. The problem? The process has become painfully slow. The average resolution now takes 744 days, more than double the original 330-day target. In fact, many cases are settled before reaching a final verdict because nobody wants to wait that long. So IBC has largely solved the moral hazard problem, but not yet the efficiency problem. Want to know what's driving emerging markets in 2026? Surprisingly, a huge part of the answer is just three companies: TSMC, Samsung and SK Hynix. Look at the chart. Emerging markets have massively outperformed the US this year, but remove these three semiconductor giants, much of that outperformance practically disappears. It's remarkable. We're talking about an asset class spanning dozens of countries, millions of people. Yet a handful of AI-linked chip champions are doing an outsized share of the heavy lift. The lesson isn't just about technology, it's about capital. For decades, if you thought offshore wealth, you thought Switzerland. In 2026, Hong Kong edged ahead with $2.95 trillion in cross-border wealth, just surpassing Switzerland's $2.94 trillion. But this isn't really a Hong Kong story, it's a China story. Over the past 2 decades, China has created wealth at a scale rarely seen in economic history, producing thousands of millionaires, hundreds of billionaires, and a new generation of family offices. Much of that money did not need to travel halfway across the world, it simply crossed the border into Hong Kong. The result? Hong Kong has become the natural vault, gateway, and financial hub for Asia's wealth boom. 5 years ago, Apple India generated 22,845 crores in revenue, less than half of Hindustan Unilever's 47,028 crores. Fast forward to FY26 and the script has completely flipped. Apple India is projected to hit 1.43 lakh crores in revenue, more than 2x of HUL's 64,468 crores. The most remarkable part, HUL sells everything from soap and shampoo to detergents across millions of households. Apple sells premium smartphones and gadgets to a relatively small slice of India's population. That's what a 44% annual growth rate for 5 years looks like. Apple's India revenue has grown 6.2 times, turning what was once a niche premium brand into one of the country's largest consumer businesses.